Hello class, this is Dr. Branch. I want to talk to you today about predatory lending and its dangers. Predatory lending and its dangers. So a little background, quite often we use the word loan shark, and a loan shark is a person who offers personal loans at extremely high interest rates. And it used to be that back in the day, the interest was called the vigorish, or for short it was called the VIG. And the idea with these loan sharks on the street was if you can't pay back the principal, at least you can make your interest payment and then I won't break your knees, basically. Very famous loan shark was a guy named Frank Calabrese Sr. with strong mafia ties. And these are the sort of people who would, if you weren't able to pay, they didn't really want to injure you too badly because they wanted you to work and pay them back. But the more often you paid your interest payment as opposed to paying back the nut or the basic, the principal, they were happy. Shylock from one of Shakespeare's plays is also a common name for a loan shark, sometimes with anti-Semitic overtones, so I don't use the term. Payday loans, I say all that to tell you that payday loans are a form of loan sharking. So what are payday loans? Predatory lending and cash checking stores is what they are. There's payday loans, check cashing, title loans are a bit different. So we're going to talk about all these. Here's how a payday loan works. Let's say your car broke down and you decide to borrow $300 for the repair from a payday lender. You will write a post-dated personal check for $340, and then the check cashing store or the payday loan store will give you $300. So the idea is you don't have $300 today to repair your car. So you write a check, let's say today is September 1st, so you write a check for $340 dated September 16th. The agreement is they'll give you $300 today, and then you will have enough money in the bank to cover that $340 check, which they're going to cash later. So it's basically you're paying $40 for borrowing $300. So you write the post-dated check made payable to the lender. This is often done online. It's usually a set period of 14 or 15 days, somewhere along that. When the period is up, you pay the lender the $340 in cash, or the lender just deposits the check you wrote. However, if you don't have enough money to pay the debt in full, then you can be charged an additional fee. Do you remember when I told you earlier, back in the day, the loan sharks on the street working for the mafia talked about the vigorish. You can't pay the principal or the nut, so you pay the vigorish. You pay the interest. That's essentially what's happening here, only in more sophisticated terms. People who can't repay the entire bill are simply paying the vigorish. And again, this is a form of loan sharking, and it basically charges people a rate of interest up around 391% per year. It says here, I have on the slide, approaching 400%. It's really about 391%. And by average, the typical APR on a credit card is about 20 to 30%, and that's high enough as it is. So rollovers are how these businesses really make money. This will be on the exam. I want you to know rollovers. Rollovers are how these check cashing stores make money. If you can't afford to repay the loan which you incurred, you pay the rollover fee, which is essentially the vigorish or the interest rate of some sort. And that's where they make their money at, by keeping people on the hook, and they just keep paying the rollover. This fee does not reduce the amount the person owes. And if someone rolls over the loan multiple times, it's possible to pay several $100s in fees and still owe the amount you borrowed. For example, if you roll over a $300 loan with a $45 fee 3 times, you will pay 4 fees or $180, and you still owe the $300. So in this example, you would pay back a total of $480 for a $380 loan. So here's the key point along with the rollovers. They can't afford to pay the principal, so they pay the rollover fee. Here's the major point. Renewing the loan is affordable, but paying them off is not. And then these people, poor people, are caught in these cycles of predatory lending where they can't pay off the principal. They can just barely pay off the principal, or the interest or the vigorish every 15 days. Check cashing is a little differently. A customer check cashes his or her check at the check cashing store instead of the bank, and then the check cashing store charges a fee to cash the check. The check cashing business, typically their fees are 1 to 5%, and So here's how this works. John Doe is an unemployed truck driver who gets a $785 disability check every month from the government. So he goes to the check cashing store to get it cashed. They charge him 1.9% or $14.92. For someone already poor, this $15 is something he badly needed. So it's predatory lending is what it is. Some will also pay a bill for a small transaction fee. So what this means is they can pay their bills online. Sometimes they pay a small fee to have their bills paid through the check cashing store for different reasons. So why do people use them? Well, these check cashing stores are targeted towards people who do not have bank accounts. So if you don't have a bank account and you need to pay a bill online, how do you do it? Well, you do it through the check cashing store. If you don't have a bank account, who's going to cash your check? The check cashing store. So one of the most important things we can do in helping people break cycles of material poverty here in the United States is to help them get their own bank account. This is a very important thing to do with your children as well. Get them their own bank account. So the convenience, they're offering poorer communities with fewer banks. And again, this is predatory. They don't put tons of these things in the wealthiest parts of town. They put them where they know people are more desperate. So banks are even getting in on the action to a certain degree, and you can read about that in my notes, but I want you to focus on the check cashing stores. Check cashing stores cost more than banks. For example, cashing a $1,500 US dollar check might incur a 3 to 5% fee at a check cashing store. So that is $45 in fees, and even a 1% fee would be $15. These are extraordinary amounts of money for people who are already poor. Most banks charge a monthly service fee of about $10 to $15, but those service fees can be avoided if you have enough money in savings. And so, again, we want to teach people, get a checking account at a bank, get it open, and then get savings in the checking account so you don't have to pay the fees, and you save yourself a lot of money. $15 is a lot. If you think about it, that's 3 gallons of milk for a family right there. Think of it that way. That's 3 gallons of milk. So title loans. A financial institution agrees to make a secured loan against the value of your car or boat or something like that, four-wheeler motorcycle. You keep and drive the car, but the lender keeps the title as a security for repayment of the loan, as well as a copy of your keys. And they keep a copy of your keys in case they want to repossess the car or you haven't paid off the loan. So the $63 to $180 for a 1-month $500 title loan. The monthly finance charges of 25% amount to 300% annual interest. So this is predatory lending, 300% for a loan. On average, title loans are roughly 3 times higher than payday loans because somebody's bringing some collateral into it. And so the average loan is $950, and it took them, the average person, about 10 months to repay that, meaning they'll spend about $2,100 to borrow the money. What's even more dangerous is, I know I have students outside the United States taking this class, but here in the United States, owning an automobile is essential to having a job in most parts of the United States where public transit is not available. So if you have a title loan on your car and then that gets repossessed, not only do they have your automobile and they have equity, but they also have taken away your ability to get to and from work. So these are quite predatory. Who uses predatory lending and why? Around 12 million Americans, an average of 8 loans of $375 per year. So those who, among these 12 million who take out loans, these predatory lending loans, on average they take out about 8 of them, and they typically spend about $520 in interest in a year. And 5.5% of Americans have used this sort of predatory lending within the last 5 years. And the data is, and within this 5.5%, the data is higher for those who are divorced or separated, especially women. Divorce is very bad on women financially. It's also much higher for African Americans. And they also tend to be repeat customers. If you do it once, you're more likely to do it again, and that means you're paying even more in interest rates. It's interesting, if you look at the income of people who are using payday loans, it's not the poorest of the poor who use it most frequently. It's people just above the very bottom of the barrel, if you will. So it can lead to terrible cycles of debt. Here you get an idea. This is the payday loan cycle. I like this little chart right here. Someone gets a payday loan, they receive a paycheck, they pay back the entire loan plus the fees, but then they don't have enough money, so they have to get another payday loan. It just goes on and on and on. So that's why some of these people are getting as many as 8 a year, if not more. So these, again, all this graph is showing you 76% of the loans are to borrowers who just had a loan. That means they're caught in the payday loan cycle, which you see right here. It is most common for borrowers who don't have access to credit cards or savings accounts to use this type of lender. So again, the way to get people out of payday loans is to teach them to save money. We talked about that in our last lecture in chapters 7 through 9, the importance of wealth accumulation for poor people. Since these loans don't require a credit check, people have no credit or credit problems often turn to payday loans. That's another reason why they go there. Military personnel, although the federal rules have changed somewhat, try to protect our soldiers, sailors, Marine Corpsmen, and Marine Corps and Coast Guardmen. But quite often it's to people at the edges of life. They're just on the cusp of absolute poverty. Drug addiction, gambling habits are another thing that feed these loans because people want to gamble. They can't wait, convinced they're going to win. And it's usually a crisis, either real or perceived. And that's one of the things in discipleship, helping people learn the difference between what's really a crisis and learning to wait. Not being able to go to the movies with your wife is not a crisis. Not being able to put food in the refrigerator, that is a crisis. A study from the Pew Charitable Trust said 58% of payday loan borrowers have trouble meeting the monthly expenses at least half of the time. And only 14% of the borrowers can afford enough out of their monthly budgets to repay an average payday loan. So who uses predatory lending? Some more information. Payday loans do not eliminate overdraft risk, and for 27% of borrowers, if they do have a bank account, it can directly cause an account overdraft. And 41% of them have needed a cash infusion to pay off a payday loan. That usually means a family member bails them out. So almost half of these folks break out of these payday loans by having somebody pay it off for them. Remember, what I want you to remember for this exam about payday loans and predatory lending is people can't repay the amount of the loan, but they can afford to keep the interest payments made. So they're just stuck in that cycle. So there's several reasons why people typically get payday loans. One of the things I would point out is predatory lenders typically target minorities, the poor, elderly, or the less educated. They have no savings. Often illegal immigrants are caught up in payday loans. So again, teaching people to save money, teaching them the difference between what a real and a perceived crisis is, and getting them to open their own bank account. These are all central to getting people to stay away from payday loans. And the number one reason being they have no bank account. So let's talk about some of their arguments that are used in favor of them. They're going to say, well, banks charge fees. Well, that's true, but by saving money and keeping a certain balance within the bank, you can avoid most of these fees. The check cashing store always charges you a fee. There's never any way where you don't have a fee. We are convenient. We have better hours, our locations. You get the money cashed. You don't have to wait for the money. Yes, drug dealers could say the same thing. In fact, one job of regulation is to rein in predatory behavior, and so they're saying they're convenient, but from outsider it looks like you're going to a place where people are weak and they are prey. You look like a hunter going after prey. Sometimes they'll say, well, basically deal with us or deal with the mafia. If we weren't here, at least we have some legalized recourse. We're not out breaking kneecaps. And the answer is loan sharks will never be eliminated. The aim of public policy ought to be able to minimize both varieties and not just the violent species. So, yes, I don't want the mafia either. So I want a government that reins in both violent and nonviolent loan sharks. 32 states allow payday loans, and 18 states are the District of Columbia make it illegal. So it just gives you an idea of the payday loan usage by states. Missouri has a pretty high level of payday loan usage for my students here in Missouri where our school is located. I suspect some of that is as well as driven by casinos because people want to gamble and they're convinced that's their way out. Here are states that don't limit payday loans or interest at all. Those are the most predatory. And here are the states with the most restrictions. I'm going to scoot past the payday loan specifics in Missouri and Kansas. Let me get to a biblical analysis. First of all, God's not opposed to a prophet, but God is opposed to those who take advantage of the weak, the poor, and the vulnerable. And there's a difference between earning a fair profit. There's between that and exploiting someone exorbitantly for the privilege of borrowing money. Predatory lending conflicts with God's plan for human relationships. We're to care for one another, love one another. It's not a loving and compassionate thing. Now, in regular business, if I produce a product someone needs, like a home computer or a car, and they pay for it, they get a tangible product that adds value to their life. I earn a profit. Everybody comes away with a win-win. In payday loans, it's not win-win. It's win-lose. I'm going to exploit you. You're going to pay 300% or 391% interest for the privilege, I'll say that loosely, of borrowing this money. Predatory lending is a direct violation of the love commandment. We're to love our neighbors, and it's a commandment opposes that. Predatory lending fails to respect the dignity of the person created in the image of God and interferes with human flourishing. So I got that statement from a Southern Baptist. In fact, much of my critique here comes from a very fine resolution passed by the Southern Baptist Convention in 2014, in which we said we oppose predatory lending. So I hope this has been helpful for you. In a class on wealth and poverty, I wanted you to understand the basics of how people get caught in these predatory lending cycles. And for the final, what I want you to remember is they can afford to repay the interest, but they can't afford to repay the principal. That's called rollover, and they wind up paying much, much more than they ever borrowed. And that's because they can afford to pay the interest, the vigorish, but they can't afford to repay the principal. Hope this has been helpful for you, and I'll see you next